This podcast episode is for investor education purposes only and is not intended to provide and should not be relied on for investment advice. Consult your personal investment advisor before engaging in any securities transaction.
Coming out of the shutdown, we're still flying with limited instrumentation, and the markets are discounting a bunch of news it doesn't have access to. This week, we'll start setting the stage for the return of the government and prepare for the end of the year. Welcome to the Wise Investor Show podcast. I'm Chase Hinderstein. And while there hasn't been a lot of earth-shattering or market-moving news this week, and information is just still constricted a bit in the final days of the government shutdown, the most notable dynamic was this broader strength in the stocks to start the week. There was this positive reaction to the end of the shutdown that really was at the expense of the AI trade. We saw broader moves upward in most sectors, except some of the most notable tech names were giving back a bit of their recent gains. And then ultimately, as the week wound on, we saw a broader sell-off. And this was first epitomized on Wednesday when almost all of the Mag 7 names were down for the day. And the biggest winners for the year amongst them were actually down 2 or 3% on the day. And that pulled down the NASDAQ, but at that point, the S&P overall was still managing a gain despite the heavy weightings of those companies in that index. And the Dow was clearly in the green for the day, and we're trumpeting, had people saying, wow, all-time high. It was this brilliant, tremendous day. The Dow was actually up less than 0.5%. But over 4 stocks in the S&P 500 were actually up for that day versus each stock that was trading lower for the day. And then that continued at first into Thursday when the broad indexes were lower, but there were still actually at the time more stocks trading higher than lower. And then as the day wound down, we start seeing more and more red. By the time you listen to this, well, who knows? But that's somewhat of an example of the concentration of risks and only a few names, stocks which are very highly correlated with each other. Their businesses are related to each other in the tech sector, whether it's AI, clouds, data storage, what have you, and all these other high flyers, the lesser-known names maybe that are just really littered throughout portfolios these days because people have been chasing what's working. But it has been ugly in tech. The NASDAQ is now off, more than 5% from its recent all-time high. And, I guess I should encourage some perspective because it's been an absolutely outstanding year for tech, and that NASDAQ is still up 18% for the year. But a few more bad days like this, and we might have a proper correction on our hands. And that's probably one that could be bought if there's anyone out there who's not already overweight that space. If you've somehow stayed on the sideline this long, well, maybe you can buy a little. Maybe a nice reminder that these things happen. Both the S&P 500 and the NASDAQ saw over 15% correction in just that first week in April. And ultimately, they closed that month higher than they were where they finished the end of March. But some of the activity this week has been blamed because, they need something to blame it on. But it's being blamed on potential weakness in employment, which I'll get to it a bit after I break later. But it's really not what's affecting the tech names, more than the average names. But it's causing this broader angst, I think, as to the health of the economy. But then if that's the case, then if the economy is showing softness, we should get rate cuts, right? And it'll all be fine. Well, if that's the case, then the threat that would derail this whole thing would be inflation. If the Fed does and is ready to use ammunition in the face of a modestly slowing economy, then the equities will find footing after a brief pullback. But beware any signs that estimates are too high, and both employment and earnings may be slowing while we're also seeing inflation at the same time. If that's the scenario, then it could be a more rocky ride than just a little pullback. And that's not a prediction, but what if? So that's not very helpful. But we did get to move forward this week and see the government reopen and maybe start to normalize at the time of this recording. Our respective flights on Thanksgiving will hopefully not be delayed any more than we'd expect them to be, although we're still behind in the data that's available to gauge the economy and which the Fed uses to make its interest rate decisions. And when there had previously, probably my last broadcast, I talked about this high probability of an interest rate cut again in December. Well, today the Wall Street odds are now 50-50 as to whether they're going to cut in December. And at this point, if they don't cut, well, the market is pricing that in. That's probably what we're seeing here. When it had been leveraged to the assumption that we're going to see 3 rate cuts, that rates are continuing to head lower, and well, now if they do cut, it'll hopefully be taken as a pleasant surprise. It's not as much priced in, and it's not going to be taken instead as a reaction that things are getting worse, as there have been signs that the job market is softening here through these less reliable readings of third-party sources while the shutdown persisted. Now, maybe not big news for the week, but noteworthy, kind of below the fold for people old enough to remember when there was a fold in the newspaper. Goldman Sachs issued a report to finish off the year whereby they provided their equity forecast for the next decade. And it got some attention because this year they posted that they expect the U.S. stock markets to lag other developed and emerging markets on average for the next decade to come. But they built into that they now expect the U.S. stock market to average a 6.5% return annually over that period. And that is a big change over where that same group put out a report 12 months ago whereby, and that got a lot more attention than I talked about, they had forecasted an average return over the next 10 years for the U.S. markets of 0% per year for that period. And I discussed it at the time, and I pointed out into that report a year ago that it was largely driven by this concentration of in the indexes of a very small handful of stocks. And I'm talking about, and the valuations in these stocks are elevated. They were elevated then, and that's what they were confronting. So they concluded then that it would be hard to manage much from the indexes, but that within the index there are, and there were then, and I guess they're more bullish now, they could say, many sectors and individual stocks which offered opportunities. They were trading at more reasonable valuations. And this year, they echo some of that same valuation concern, but they got more bullish on the ability of these companies that are trading even more expensively than they were last year, but they're more bullish on their ability to grow earnings. As they pointed out that the 6.5% return that they forecast for the U.S. is going to come entirely from earnings growth and from dividends, buoyed somewhat by share buybacks, while valuation expansion, which they think still largely be absent from that formula. And this year we got more valuation expansion. And in that report, Goldman suggested a bigger focus instead on the foreign markets. And they have the European stocks averaging a 7.1% return per year, Japan 8.2%, even higher from other parts of Asia outside of Japan, and the emerging markets averaging an almost 11% annualized return for the American investor. And I say it that way because they're also factoring in an added return that they'd expect from a continued relative weakness in the U.S. dollar, which is similar to what I've been talking about in recent podcasts, the same thoughts essentially that I shared from people over at J.P. Morgan. Goldman went on to point out that in Europe, which is a bit more stable, I shouldn't say stable, but it's not as AI-focused in the stock market. I say it that way, leave it at that. But considering the allocation overall, they consider Europe also more stable rather than backing up the truck on this emerging market call. So that doesn't mean just pick out the highest return and put the lion's share of your portfolio in the emerging markets. I don't think anyone's going to do that. But they say that Europe has the expected benefit from this relatively soft dollar, but a much higher contribution coming from dividends than we expect to see in the U.S. markets, which then also benefits from the currency exchange. You're getting a dividend issued in euros and then it converts to a dollar that might show a year-over-year weakness versus that euro. So an average yield in Europe of 3% on stocks really helps their indexes provide that total return versus the U.S. indexes in their relatively lower dividend payment. Lastly on that, though, they did hedge a bit. So I don't know if this is worth anything, but they pointed out that they're basically utilizing their analysis from their foreign exchange team on this currency call. And, quote, they expect the depreciation to be front-loaded over the next 12 months with a subsequent drift afterward, end quote, meaning that they're not building in this currency call, this currency kicker on the premiums here beyond 2026. They're not going to guess what happens after that. But they are, and many people have been, more and more bullish on a relative basis on Europe versus the U.S. markets for next year at least. Now, we didn't get CPI data this week, and I don't think we're getting PPI either. So there's this big gap between indications of what inflation may look like. But absent the tariffs and with oil prices, and again, absent the tariffs because we are seeing some deals and such, and we'll see what happens with the courts. But oil prices are lower. Inflation just doesn't look too hot right now. We may even get this shocking development if the Supreme Court does rule that a bunch of the tariffs have to be reversed. But regardless, most of these tariffs are being negotiated to a more tenable rate than some of the bigger threats we've seen this year. So the smart money has to still be on a more dovish position for the Fed over the coming months. But today, still working their way down from this restrictive position of battling inflation onward towards neutral, which Jerome Powell said recently, really, he thinks isn't much lower than they were today. And Strategists, the people at Strategists had an interesting report this week, if you find these types of things interesting, where they talked about the history of the neutral rate. And the neutral rate doesn't have an official calculation, but there are these models that take a theoretical guess to them, and they're all over the place. But where this interest rate policy is neither hurting nor helping the economy, where it's completely neutral. And they pointed out that in the latter parts of the 20th century, that neutral rate trended down from roughly 4% for kind of the middle of the century to a rate that where neutral was really below 1%. Which at the time, Fed Chair Ben Bernanke said he thought it was due to too much global savings in U.S. dollars, which was empowering our dollar to be strong and keep the neutral rate low, and also possibly due to greater globalization as the 20th century wound on, and therefore cheaper goods. Well, both of those things are obviously changing now. The dollar is weakening. And this is not dollar hysteria, but on a relative basis, the dollar has shown some weakness this year and relative to these other currencies. And those other currencies are having a bit of a bigger say in things. So, the dollar is still by far the dominant player in the global currency markets. There's no real competitor on a liquidity basis that can replace the dollar. So I keep qualifying how I'm saying this, but with a bit of a softness in the dollar and certainly a bunch of challenges to globalization in these trade wars such as they are, that effect would be reversing this neutral rate effect. And since the Fed funds rate today is already below 4%, well, maybe we are getting pretty close to this neutral rate today, even though one of the Fed's models, which does try to produce this number, shows that it's still around 1%. Again, they have, in this report, half dozen models or so, which had a 3% delta between them. But the language coming out of the Fed's governors is that we're close to it here in a 3% and change range. Now, the concept has a very real impact. There is somewhere a neutral rate out there, but it's basically unknowable, at least specifically. And what's more important then is instead of trying to find out where it actually is it is important to find out where the Fed believes it is. And to that, Strategist concludes after examining these half dozen models that the Fed may engage to empirically project the rate. They might try to. That what history shows, though, is that, quote, estimates from the Fed have been largely unmoored from reality, end quote. And this is in itself kind of dangerous because the Fed's overall mandate is pretty clear and evident. And they react to economic data to decide if they want to be focused on fighting inflation or supporting and boosting employment. And hopefully one outweighs the other. And if it doesn't, then they should be at neutral. But if it is shown which is what Strategist is trying to do here this week, that neutral is very unknowable and it varies quite a lot, then the Fed is actually really flying blind, essentially. It's kind of like targeting a rocket with having only a two-dimensional formula, knowing that they want to raise rates to fight inflation, for example, but if they don't really know where they are relative to neutral and inflation, they can only control the directionality of their rate moves, and they have no real feel for an actual target. And, they may disagree, but that's a scary thought. And with that scary thought, I am going to take a quick break here, but I'll be back in a minute, and I'll try to get refocused a bit on actual employment and the markets and the economy. For the Wise Investor Show, I'll be back with that in a moment.
The unwieldy fire hose of daily news flow is only getting stronger. How do investors separate the noise from what actually matters? Tune in every week as we discuss the latest financial trends and how to filter what's distracting you from investing success. Listen to us at The Wise Investor Show at raymondjames.com/The Wise Investor Group. Or just find us on your favorite podcast app. Raymond James Financial Services Incorporated, member FINRA, SIPC.
The information contained in this podcast represents the opinions of the hosts and guests and does not necessarily represent the views of Raymond James and Associates, Inc., the Wise Investor Group, or their respective affiliates and employees. This podcast is for investor educational purposes only and is not intended to provide and should not be relied on for investment advice. The contents of this podcast do not purport to constitute a comprehensive summary of all information necessary to base an investment decision. Past performance is not a guarantee of future results. Securities mentioned in this podcast may not be suitable for all investors. Seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your individual situation. Discuss any tax or legal matters with the appropriate professional advisors. Raymond James and Associates, Inc., member New York Stock Exchange, SIPC.
Welcome back to the show. While I do feel like I was rambling there a bit, maybe even more than usual, but it's hard when we got one arm tied behind our back. The markets are in a bit of turmoil, and we don't have as much information as we usually have with the government shutting out so much economic data. But we do have earnings, and ultimately that's more important than anything else. I mean, while I'm not getting into any individual stocks here today, but if you could have all the forward data, everything available on one or two companies, you knew what they were going to earn in the future, you knew what their sales were going to be, how they're going to use that cash flow, that earnings, well, then the economic data and such wouldn't matter that much. But we have to take educated guesses as to what comes next, and that comes with a lot of help from the companies themselves. They give forward guidance as to what they're seeing, and that's why when a company, and we see a lot of this recently, a company can come out with pretty strong earnings. They beat top line, beat bottom line, but if they have an oopsie and slash their forward guidance, that's what a stock's trading off of, really, what they expect. And if they lower expectations, that hurts a lot. But we take a look at that, and then we cook in a bit of forecasting for the economy, and hopefully we take an educated guess at what these future outcomes would be, because you don't have all the information for the future. Well, the third quarter earnings season for the S&P 500 is largely done now, and 82% of the companies in the index have announced positive earnings surprises, according to FactSet, while 42 of those companies have unfortunately announced negative guidance, and 31 have issued positive guidance. And while that sounds pretty bad, that's actually better than most quarters over the last few years. And despite that, the S&P now is up since the end of the quarter, albeit only up 1% now since September 30th, and it's about 3% off its all-time high. And there's a lot cooked into the market based on forward estimates now, not just next year, but especially for these high-flying companies, really 27, 28, and 29. And per FactSet, the S&P 500 is now trading at almost 23 times next year's earnings estimate. And that is above the 5-year average, which was 20 times forward earnings, and the 10-year average, which was only 18.6 times forward earnings. And for what it's worth, though, these companies, which are now tempering expectations a bit, are also reporting. So there's, like I said, giving negative earnings guidance, but they have on aggregate reported a combined 13.1% earnings growth rate for this third quarter for this year. And the FactSet consensus estimate is that the market is going to see revenue growth of almost 7% for next year and earnings growth of 13.7% for the year. And they have, if they take all the analysts in their consensus, they have an average price target now in the S&P 500 for next year of 78.36, which is 16% higher than it is today. And, this may make the case to justify these higher valuations, or, it may reflect also or instead that there's too much optimism. But it is likely a recipe, therefore, for volatility. And if the fundamentals of companies are sound, then the volatility that we may see, and this week has been a little bit of that, it could be an opportunity to buy great businesses a little bit cheaper, as long as your weightings and the time horizon you have are based upon a solid plan. So to wind this up with a bit of doom and gloom, as maybe is my nature, JP Morgan has been focusing recently on the challenges we're seeing in the labor and household incomes, which is bringing this all back to where I started with this emphasis on focusing on the health of the consumer. And in a report this week, the folks over at JPM said that the beginning of the cycle was powered by this very strong job growth and wage growth with that was outstripping the inflation that we were all complaining about. Remember when people were just quitting their jobs and finding new ones and the wages were incredible? Well, yeah, the hamburgers were incredibly expensive, but households were doing really well, and it led to large gains in consumer spending. Well, they're now pointing towards cracks in the G4 nations, which is not us, but they're seeing adjusted income growth and spending slowing, leading to lagging GDP growth in those nations, which in their case says could be a canary in the coal mine for the broader developed economies. And we could counter that by pointing to within those G4 nations, there's additional stimulus coming in to help at least Germany and Japan. So, this isn't specifically an alarm bell at this point, but it's reinforcing my notion that the consumer needs to be watched carefully as we move along here. And once again, it wraps back around to the Fed, where the Wall Street Journal said in an article this week, quote, "Officials are fractured over which poses the greater threat, persistent inflation or a sluggish labor market, and even a resumption of official economic data may not bridge those differences," end quote. And that's something else we've seen with a bit of a reshuffling and more to come on that Fed board, where there's a bigger disparity of opinions and approaches than we've historically had. So we're getting a little bit more divisiveness there. And Wall Street Journal went on to say, quote, "Doves worried about labor market softness but lacked new evidence that would maintain a strong case for cutting. Hawks seized the opportunity to argue for a pause. They pointed to a steady consumer spending and signaled concern that businesses were preparing to pass along tariff-related price increases," end quote. So that's where we got to this case of maybe the Fed won't cut in December. I mean, we're really not ready to do this kind of end-of-year podcast theme yet, and I expect I'm going to have a handful of other official reports from various firms about their forecasts for the next year and decade coming out in the next few weeks. But a bit earlier this year than I usually do it, I'm going to emphasize that now is a great time to focus on your allocation. We've had a few good years here, and we've seen some very popular stocks, some very widely held stocks having tremendous runs, and therefore resulting sometimes in outweighted positions in some portfolios. They've seen a bit of a pullback this week, but they're not really that far off their all-time highs. And in most cases, while I pull the plug at this point, I'm going to drill down and look at what you're sitting on. Don't get ready to throw out half your portfolio. I'm not suggesting reducing your equity exposure to less than you would have targeted. But even if it was well-positioned, you had the right allocation based upon a goal 10 months ago, just the growth alone may have thrown it out of whack a bit. So see if you are to too many degrees above what your risk exposure reasonably should be. On the other hand, I do worry that a lot of portfolios out there and I mean this on an institutional level, there are a lot of money out there that I fear is just going to kind of hold their nose for now, and it's going to wait till January, and then they'll consider rebalancing a bit of this risk because they don't want to incur further capital gains this year. Well, if that's the case, if you can't afford to get ahead of the crowd, then I would emphasize try to avoid jumping in with them to start the new year if there is a bit of a washout when everyone starts to rebalance. If you can't do it now, maybe wait until the initial rush has cleared as January begins. Either suck it up and cut it back today, or if taxes are a greater concern, look away for the beginning of the first quarter. Go on vacation, turn off CNBC, whatever you have to do, and then maybe after the initial wave, if there is one, who knows, maybe the market will be up 10% by January 15th. Just don't get caught up in a whole bunch of rebalancing if that's what we expect to see next year. All right, that's it for me today. Thanks for listening in. For the Wise Investor Show, I'm Chase Hinderstein.
The information contained in this podcast represents the opinions of the hosts and guests and does not necessarily represent the views of Raymond James and Associates, Inc., the Wise Investor Group, or their respective affiliates and employees. This podcast is for investor educational purposes only and is not intended to provide and should not be relied on for investment advice. The contents of this podcast do not purport to constitute a comprehensive summary of all information necessary to base an investment decision. Past performance is not a guarantee of future results. Securities mentioned in this podcast may not be suitable for all investors. Seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your individual situation. Discuss any tax or legal matters with the appropriate professional advisors. Raymond James and Associates, Inc., member New York Stock Exchange, SIPC.